Bitcoin and gold will sniff that out, and they will see that we're going to have massive money printing to a factor of what it was before. It's not going to be $5 or $6 trillion. It's going to be 10, 15, 20 trillion dollars, because that's where we are in the leverage of the system. That's what it will take in order to re-up this just it's an endless doomed debt loop that we're in, and we've got to keep it going, and that's the only way. If we do have a geopolitical event like you're talking about, yeah, it would be catastrophic, and it's hard to say what would happen to markets.
Let's assume that the world doesn't blow up, Armageddon gets contained. We just have the usual crises of fiat debasement and devaluation and what we're already expecting there. What do you see happening as the next positive narrative driver to push the Bitcoin price higher? Hello, I'm Michelle Makori. Thank you for joining us. The Bitcoin halving is fast approaching, expected to happen around April 19th or 20th. Now, the halving takes place roughly every 4 years, or once 210,000 blocks have been mined. And this event cuts the reward for mining a Bitcoin block in half, so effectively slowing down the creation of new Bitcoins. And this time, the reward for mining a single block of Bitcoin will drop from 6.25 Bitcoins to 3.125 Bitcoins. Now, so far, around 19.6 million Bitcoins have been mined, leaving approximately 1.4 million left to be mined. And the final Bitcoin is expected to be mined around the year 2140. Historically, halving events have been bullish for Bitcoin, but Goldman Sachs says that is not likely to be the case this time, telling investors not to utilize previous cycles for price predictions. Goldman points out that the macroeconomic backdrop this time is very different. High inflation and interest rates are in sharp contrast to the conditions of previous halvings, when central banks like the US Fed and the ECB were expanding the money supply and maintaining low or zero interest rates. And there's also escalating geopolitical tension, with the Middle East conflicts heating up. So what can we expect for the halving, the markets, gold, and the macroeconomy in this landscape? Well, who better to ask than James Lavish, managing partner of the Bitcoin Opportunity Fund, which is a hybrid investment fund that makes public and private investments in the Bitcoin ecosystem. And James is also the author of the Informationist newsletter. James, great to have you back on Kitco with us.
It's great to be here, Michelle. Thank you for having me. We got lots to talk about.
We do indeed. And James, one of the reasons I'm such a big fan of the Informationist newsletter is because you take these complex financial and economic topics and you break them down in a way that everybody can understand them. So why don't we start with you breaking down what the halving is? Because it seems like there is a lot of misunderstanding around what the halving is. In fact, some people apparently thinking that it's something like a stock split. So a lot of misunderstanding with what the halving is. I try to give a brief breakdown, but I think you're going to do a better job.
Well, it's super simple, actually. If you think about it, just like gold mining, you have miners out there and they mine for gold, and there's a certain amount of gold that they'll mine per year. Well, Bitcoin is the whole protocol is overseen by an algorithm, and that algorithm is built in. It's kind of baked in that there are a certain number of Bitcoin that you mine each time that an algorithm is solved by the computers. So you have all these computers that are plugged in. They're all racing to solve this algorithm, and then they win the award. Well, at the halving, that award gets cut in half. So, and instead of, so you can think about it as it has a half-life to 2140, like you said, when the last partial Bitcoin will be mined. And so, that's what happens. So in theory, if you only had Bitcoin that was entering the ecosystem from miners, in theory, then at every halving, Bitcoin would double in price. But that's not really true, because you already have, like you pointed out at the beginning of the call, you already have most of the Bitcoin has been mined. So most of the liquidity is out there. So going to that point, is this halving less impactful than prior halvings? I would say probably it is. There's a few things though. When you think about it, there's only been 3 halvings, right? So this is the 4th one, and so it's a very small data set to look at. Is it significant? What we have seen each halving is, yes, it's been significant price appreciation after the halving. Not right afterwards, but somewhere around the 6 to 18 month period afterwards, you see a large increase in price in Bitcoin. Now, do I expect the same thing to happen this time? I do. I expect it to be similar, and the factor that it is up, the actual percentage, I'm not sure what it could be. I don't. You and I have talked about this quite a bit before. I don't love making price predictions, but I do have a prediction that it is going up and
Right.
significantly, and there are a number of reasons for that. But yeah.
All right, well, let me stop you there. I do want to circle back on a point of why this was baked into the design of Bitcoin in the first place, right? Why, when Satoshi Nakamoto created Bitcoin, why it was important to have this limited supply and to have this halving phenomenon.
Right. So you have with and I like gold. I think it's been a tremendous store of value. We can talk about that in a minute. But with anything else, there's no scarcity. There's no scarcity value to it. Really, you can just make more of most things. But with Bitcoin and even gold, you can keep mining more. Silver, you can keep mining more. When the price goes up, you see the activity of mining go up because they're trying to match that and take advantage of that rise in price. And so you can spend more money and build more mines to find more gold and more silver. But with Bitcoin, what Satoshi wanted to do is what he did was he programmed in an absolute value that will never go over. So there will only be 21 million Bitcoin ever mined. And so that is it. And so that is there. What that means is it's anti-inflationary, right? So as more and more dollars are printed, more and more yen, more and more euros, as more are printed and fiat currencies are printed, it requires more of those fiat currencies to buy one Bitcoin. And that is the absolute reason why he built it in. And that's what makes Bitcoin so strong and so unique. That's what makes it the hardest money out there.
Right. And as you said previously, halvings have been bullish for the price. After Bitcoin's first halving, because of that scarcity, after Bitcoin's first halving in November of 2012, the price rose from $12.35 to $127 5 months later. We had the second halving in 2016. The price doubled to $1,280 within 8 months there. Between the third halving in May of 2020 and March 2021, Bitcoin's price rose from $8,700 to $60,000. So again, I know you don't like to give me specifics, but generally speaking, what are your expectations once the halving actually happens? Do you have a timeline of perhaps, buy the rumors, sell the news phenomenon? Do you expect a slight pullback? Do you expect some consolidation? Broadly speaking, what are the trends that you think make sense for this halving?
All right. Well, what I expect is we have a number of different factors that are going on. Okay. So the first factor we have going on is that we just had these ETFs approved. There have been billions of dollars come into these ETFs, hundreds of millions almost every single day since the since the approval and the trading of these ETFs. They're significant for the people who don't know, who are watching. They're so significant because these are spot-based ETFs, which mean they legally must own the same amount of Bitcoin to the underlying NAV value. So if somebody puts in $1 into that ETF, they have to make sure that there's at least $1 worth of Bitcoin in that ETF to match it. Right. So that's why it's so significant. It's not like a future where it's just cash settled. It's just really just a bet on price. These are actually, they have to own the underlying. And so what we're seeing is, and I'm I was one of the people who was a little bit more optimistic and enthusiastic about when these were approved, that we would have a rush of institutions into the space. The reality is, and I understand this, being in the space for a long time, that it takes weeks and months for these banks and for these institutions to create the on ramps onto the superhighway. So the superhighway is built; it's easy to buy, and now they have to build those on ramps. But the issue has been that it's been very difficult for large institutions to buy Bitcoin. This is it's difficult to understand if you're an individual investor, because you just go on to Coinbase or Kraken, you buy your Bitcoin, you throw it in a wallet, you've got it, no problem. If you're an institutional money manager, if you're a portfolio manager and you want to buy Bitcoin, last year, if you want to do this, well, you had to figure out, and you had to get everybody in your company to understand it and be on board with you signing up for an exchange that is not overseen by the SEC. Okay, having it settled by some sort of bank or a financial company that is not registered, like J.P. Morgan or Merrill Lynch or Goldman Sachs. Then have it custody. Are you going to custody it? Are you going to take the keys? Are you going to take that personal risk if you have $100 million position in Bitcoin that you may lose the keys, or you may get some sort of wrench attack? Or where are you going to hold the keys? How is it going to be kept up with? What's the succession of that in case you leave your position or somebody else comes in? There are just too many questions, And then simple things like, where do we price it every day? Do we use midnight? Do we use New York Stock Exchange close? Do we use London close? Like, where do we price this thing? So these are, and then when you're custodying it, can we margin it? Like, there's so many questions about it that were all solved in one fell swoop with the spot ETFs, because now you can buy it on the same exchange with the same brokers and settle it with the same custodian who will custody it with you for you. And you know what the margin is on it. They probably are not getting much, if any, margin on it right now. They will in the future, but it remains to be seen. And it's a simple process. It's like buying or selling any other stock, and you can now have it in your portfolio. The question is, are the banks ready to do this? Are the institutions ready to do this? Do they understand Bitcoin enough? And they're slowly coming to that realization. They're slowly understanding it. They're watching it trade every single day and seeing there are no problems with the custody. They see there's no problem with the settlement. And so it's become easier. It's just taking time. And so we're bumping up against that, or we're kind of passing through that 90, 100-day window that is kind of a quiet period that these banks use in order to make sure that it is working the way that they expect it to work, and that the risks it's de-risked on an operational side. So now they're starting to put it in place where you can offer it to your clients if you're an RIA. You can offer it to your investors if you're at Merrill Lynch or JP Morgan or Morgan Stanley. So it's starting, and it's more of a trickle right now that I think becomes a river. But it's just taking time. So that is a major factor, though, Michelle, is that this is occurring. I am talking to people who are in institutions that are starting to dip their toe in, and it remains to be seen how quickly and who is in. But this is an important development, and it's different from every other halving. This is a significant change, and it will impact the price positively, in my opinion.
So where do you think we are in terms of percentage of exposure? You said that they're starting to trickle in. I mean, there have been pretty dramatic inflows to these ETFs already, but where do you think we are in terms of the drop, the trickle, the river to the ocean?
Well, I think right now, those people who were hoping to get it in their IRAs, their retirement accounts, and they have some access to it. I think that's, you've been seeing a lot of that. You've been seeing a lot of hedge funds use it and start allocating to it. I don't know of, and I haven't heard of major institutions I'm talking about California Pension Fund, CalPERS, or Texas Teachers, Guggenheim. I haven't heard of massive institutions allocating to it separately as a segregated asset or within their portfolio, but therein lies a significant event that we could see in the future. And that's because one of the differences here is that traditionally in Bitcoin, if you have a wallet, like you and I can't see who's behind a wallet. The SEC may be able to see it because of the know your customer, the KYC regulations through the exchanges now, but we can't see that. But what we will be able to see is when these large institutions are allocating to these ETFs, they have to file and make it public that they are an owner of that ETF. And you'll see the holders right on Bloomberg as a big list. We'll be able to see who holds what. And when one of those institutions pops up, and I'm not saying if, I'm saying when one of those institutions pops up and you realize, oh my God, CalPERS is allocating to this, that's going to be a big deal.
Do you think that that's going to trigger some FOMO? If you see that the likes of CalPERS are buying spot Bitcoin ETFs, does that mean like the other big pension funds, the big endowments sort of go, oh, we better get exposure to this?
Absolutely. That's the way they work. They say, oh, if they're doing it, well, we have to do it, because now you have you have reputational and portfolio risk yourself, because we'll go back to the days of earlier days of Yale, the endowment, and David Swenson had been allocating to these alternative investments, hedge funds and private equity and venture capital, and everybody thought that he was crazy. But then he started seeing his returns. They're like, oh, maybe we ought to be doing that too. And so he was way ahead of the game, and he kind of changed the way that endowments looked at those investments and that area. And so now all of them do it. So
right.
That's exactly what will happen.
Yeah, so much of that is driven by sentiment. James, let's bring it back to this Goldman Sachs point where they're saying it's not the same macroeconomic environment, where they're pointing out that previous halvings, we had effectively ZERP policies, we had monetary expansion. This halving on the macro side, we've got very high interest rates, not only in the US, but elsewhere. We've got high inflation. We've got a very different macroeconomic picture. How does that fit into things?
Uncertainty. We have a lot of uncertainty. Yeah.
We're not even getting to the geopolitical yet. We will touch on that.
There's tremendous geopolitical risk, and as you and I have discussed, it's pretty much being discounted in the markets right now.
But before we get that, let's focus on the macro. Let's put the geopolitical issue aside, because what we do know definitively is that it's a different macroeconomic environment. That much we know.
No doubt about it. So what do we have? We have a situation where the Fed has raised rates really quickly, from ZERP, like you said, just above 0% to 5.5% in a matter of 18 to 24 months. And so that was it should have been a major shock to the system. And we expected it to be a major shock to the system. What we didn't expect, and what we see happening, which is causing so much confusion in the economy and in the markets, is we didn't expect for the government to be so monumentally irresponsible as to spend $2 trillion plus, $2.2 trillion more every year than we're taking in tax receipts. So we're running deficits that are record size at a time that we're not even in a recession. We don't have some sort of major event that we're trying to overcome. We're just running these deficits. So we're seeing inflation stay sticky. We're seeing inflation run hot in certain areas and certain parts. And so we've got recession in certain areas because of the companies that are they're sensitive to high interest rates. You're seeing over 200,000 jobs have been lost, or layoffs that we've seen so far this year. A lot of them in technology, interest rate sensitive because they borrow a lot. And so we're seeing that. At the same time, we're seeing part-time jobs rip higher. and full-time jobs go down. We're seeing government jobs. There, on average, we're seeing a major percentage of every single month that we get our jobs numbers is from the government jobs that have been created. And so you're seeing pockets of creation there, and so pockets of inflation there, and in places like and in sectors like infrastructure, green energy. Like, we're spending so much money here, defense spending. There's just so much money that we're spending here that we're creating a dichotomy. It's producing a lot of confusion. So that's causing rates to go higher. We're seeing bond auctions that look a little troubling, right? So we had a 30-year auction back in November that was a major surprise, and that was a terrible auction. And what happened was there just wasn't as much international demand as we expected. The primary dealers were stuck with more than they wanted to be, than they normally are. And the same thing happened again with the 20-year earlier this year. Same thing happened again with the 10-year last week. And so we're seeing certain auctions that it's giving red flags. It's giving signals that, hey, investors are aware that there's going to be high inflation. They know that there's no other way for the Treasury to deal with all of the debt that they're piling on, $34.6 trillion of debt, that they're going to add another 1.5 to 2 trillion by the end of this year, that they know that there's no other way to deal with it than to allow for high structural perpetual inflation. And so that is a major deal, and that is impacting the bond markets. And we're seeing that now. And so that's one of the things that's going on.
All right. Well, a number of factors that in theory should be bullish for Bitcoin if you view Bitcoin as the Bitcoin proponents want us to view it, and that is as a better version of gold. So you've got high inflation, as we've just discussed, and it doesn't seem as though the Fed is going to be able to act to fix it in any kind of meaningful way. You've also got geopolitical tensions with the Middle East tensions escalating, the latest conflicts with Iran and Israel, which we'll get into that as well. But you've also got the halving, which is supposed to be bullish, and yet, James, we've got Bitcoin now testing 60,000 today. Right? So why? Why is Bitcoin down? What gives?
Well, first of all, Bitcoin has had a tremendous run this year, right? So it's just taking a breather. I actually look at it as very healthy that it's consolidating here. You have a lot of old OGs, original Bitcoiners that have these wallets that are suddenly being activated that haven't been active in 5, 6, 7 years. And so what we're seeing is that there are some who are trading around it, and they're trading around that high, the all-time high price. And when it goes up to 70,000, they're selling it, and it creates some consolidation where people are taking profits. They're waiting for it to actually break through. And you've had some perpetual. If you watch the futures and the perpetual markets, you see that there's leverage at that price point above 70. But so what is going on? Well, it's going to take a tremendous amount of momentum to get through that level. And once it does, that's going to be a massive emotional level, and it's going to become some sort of base for it. So that's one of the things that we see going on, and it's difficult to time that, right? So you've had this run up from the ETFs. The ETFs were announced. It was a sell the news event for a day or two, and then they've had this tremendous rise since then, and now they're kind of backing off. They're backing off because, unfortunately, and like you said, most Bitcoin proponents all Bitcoin proponents who really understand that it's a risk-off asset. It's digital gold. It's gold 2, 3, 4.0. It is a much, much more elegant solution to hard money. Now, the problem is most people don't understand that. And in the world I come from the institutional investing world, it's just seen as digital. It's a digital currency that's speculative. It's young. It's not that much different from ETH. I hear people say this all the time. Well, what happens if Satoshi shows up and sells his million coins? Or what happens if Satoshi just decides to change the code? What happens if the government shuts it down? What happens if, and what they don't realize, and what's so difficult for people to get their head around, is that this is truly decentralized. It doesn't have anybody in charge of it. Satoshi's not in charge of it. The Bitcoin ecosystem stretches across the entire world. And so that is what protects it from bad actors and change in the code. And so, but it's going to take time for people to understand that, especially in the institutional space. And once they do, then it'll move from being a risk on asset to becoming a risk off asset. And when that happens, you're going to see Bitcoin not just take a little bit of market share from gold, but and I don't think it's going to demonetize gold completely, at least not for a while. But once it does do that, you'll start seeing people allocate out of their long bond portfolios into Bitcoin. Because why on earth would you be invested in a 30-year treasury that's yielding 5% when you know that the expansion of the money supply is over 7% for the last 50 years? Why would you do that? It makes absolutely no sense. So eventually you'll come to that realization and you'll know that Bitcoin is a much better store of value than a long bond, even the US Treasury.
But we do see US assets become a flight to safety, even with $34.6 trillion of debt, when we start to see geopolitical tensions. And we saw that again, over the weekend when Iran launched that unprecedented assault against Israel with over 350 ballistic missiles, cruise missiles, and drones being fired at Israel. And we saw Bitcoin falling from 68,000 to below 62,000. Gold was rallying on expectations that this would happen. This was a very well telegraphed attack. Iran was saying that it was going to respond to an alleged Israeli strike on an embassy in Syria where 12 IRGC members were killed, 2 senior generals of the Iranian Revolutionary Guard Corps, which was designated a terrorist organization by the Trump administration. But Iran made it quite clear that there would be a retaliation for that attack. It was expected, at least in the gold market and in the oil market, that there would be some kind of reprisal for that. But come the weekend, as this was happening, Bitcoin is the asset that tanks, that takes it on the chin, and that is still taking it on the chin. Why is that, James?
So let's talk about that. So first of all, Bitcoin. So if you're an asset manager and you have uncertainty in the markets, and you know that Monday morning you're going to walk in and you don't know what's going on, especially if it is an attack that escalates and you've got a full-on war going on. If you have a 9/11, something like that. When in periods of major market uncertainty, you have distress. And so if you're a money manager, if you're an asset allocator and you're a portfolio manager in an institution, the hedge fund or some of these other institutions, you walk into your trading desk and you just say, sell 10% of everything. Just sell 10. I don't have the time to work through the portfolio to see what is at risk with this particular geopolitical play. Just sell 10% of everything and get me some cash. I know I'm going to need it because I'm going to get margin calls somewhere in my portfolio. So I have to raise cash, and you just sell what you can sell, not what you need to, or effectively what you should sometimes. And so why is Bitcoin trade? Well, Bitcoin trades 24/7, 365. It never shuts off. Every single 10 minutes or 9 minutes and change, there's a new block that settles. And so that Bitcoin is something that you can sell and you can raise cash in prior to the open of the markets Monday. And that, well, if I sell it down 4 or 5%, that's not that big of a deal. The markets could be down 5, 10, 6, 15%. Well, once the breakers let up. But you can do that and raise cash quickly, and that's why Bitcoin it has to suffer that. And it's kind of it's going to continue this way until we have markets that trade on par value and time wise to Bitcoin 24/7, which I don't see happening for a while.
Well, so then that brings up a great point. I mean, does the fact that Bitcoin markets are open 24/7 and you don't have breakers in Bitcoin markets, I mean, with the spot Bitcoin ETF, breakers may kick in, but that's back to the traditional market. If we're talking about Bitcoin on exchanges and Bitcoin markets globally, does the fact that you don't have those circuit breakers and that the markets are open 24/7 continue to kill Bitcoin's upward momentum in situations like this when you're not having the same exposure to that sort of risk sentiment in other markets due to the fact that they're closed? They're just closed Saturday, Sunday.
Absolutely. And for the short period, yes, it will suffer that. But to me, they become buying opportunities. And so, because I understand the protocol, and to other Bitcoin investors who understand the protocol, they become buying opportunities. At some point, Michelle, I fully expect for that to change over and for it to go from risk on to risk off. Like I was saying before, once we get that full understanding and you have allocations across the board, this will be a risk off asset eventually. It's just not there yet. And so we're going to have to kind of gut it out until it gets there.
But it doesn't change the market mechanism, right? The market mechanism, and we don't see traditional markets now open Saturday, Sunday, and we're not going to see Bitcoin markets closed Saturday, Sunday. So you're always going to have to have that imbalance, I suppose, of the decentralized nature of Bitcoin, which is, one of the big pluses as well, potentially, counting against it. Let's focus a little bit more, James, on the geopolitical situation here, right? Because as we said, you do believe that Bitcoin will take its position as a safe haven asset eventually. What are you doing now with regards to Bitcoin, as we're seeing the price down ahead of the halving and potentially an increase of a geopolitical event happening? Are you buying more Bitcoin right now?
I am, and I'm buying it all the way down because, especially with my hedge fund, because we don't have a 6-month view. We have a 7-year plus view. And if I can buy Bitcoin at these prices, I know, or I am extremely confident, I have a very high degree of confidence that the risk reward of buying Bitcoin here it's a tremendous value. And so I know that if I believe that Bitcoin will be $1 million someday soon, whether it's in 2030 or 2035, that I know that buying it here, the market is discounting that on just call it fair value. We won't do present value because it doesn't even make sense with where inflation's going. But just on fair value, I know that the market's discounting that to somewhere around a 94% probability that it's going down to zero versus a 5 or 6% probability that it's going to $1 million. That's a great value for me.
Okay,
and I'm super excited about that.
Break that down again. 94% probability.
It's not exact math. I'd have to get technical, but for the ease of just a glance at it, for people who are just glancing at it, I've had posts on it on my Twitter about how to break it down. But basically, you're just looking at it and say, if it goes to $1 million, so you take $1 million, and where it is now, it's at 50,000. Well, it's at about 5% of $1 million, right? So 50,000 is about 5%. So what's the difference? It's 95% chance that it's going to zero rather than a 5% chance going to $1 million. And that's just a glancing value. It's a little bit different than that because you actually would use a matrix, and you would do a lot of them. And then you would look at what you actually believe the downside value is. And most people don't believe zero. Some do. Peter Schiff does, but I believe
I think he's the only one that's left.
He's quite wrong, but that's okay. He can stay stubborn. But you look at those values, you look at those downside values, and you calculate it out. And so my number is a little bit different than that, technically, but it's the same exact approach to it. And that's when you look at it and you say, do I believe that there is a greater than 5% chance that Bitcoin goes to 1 million? And if the answer is yes, then you could do it with any number. You could say, do I believe it's a greater than 62% chance that it goes to 100,000? If I do believe that, then I should be buying it here. And I fully believe that. So you were asking before, where do I think Bitcoin goes? I would be shocked if we don't hit, if we don't hit 100,000 plus Bitcoin this year. And the reason we wouldn't is because of timing around the election, around some sort of geopolitical event. And it takes too much time between the time of the event and the tsunami of money printing that we will see after that event. But Bitcoin and gold will sniff that out. And they will see that we're going to have massive money printing to a factor of what it was before. It's not going to be $5 or $6 trillion. It's going to be 10, 15, 20 trillion dollars, because that's where we are in the leverage of the system. That's what it will take in order to re-up this just it's an endless doomed debt loop that we're in, and we've got to keep it going. And that's the only way.
But you're saying that it hits $100,000 by the end of 2024, unless there's a big geopolitical event. But, it feels as though the pieces are moving in position for a big geopolitical event. Certainly not anything that we're rooting for. But if we just look at the developments and at the escalation, I mean, the latest that we're hearing from this is we have a statement from Iran's president, Ibrahim Raisi. He's vowing that he would completely destroy Israel if it proceeds with even the tiniest invasion of its country. Raisi made the comments at an annual army parade. So obviously some saber rattling there and playing to the audience, at least the part of the Islamic regime that wants to hear that kind of saber rattling. I always like to distinguish between the Iranian people that do not necessarily support the Islamic regime and the people that he's pandering to. And he's declaring, and I'm quoting here with the translation, nothing would remain from the Zionist regime. That's according to the official IRNA news agency. Iran, as we discussed, is bracing for a potential Israeli retaliation after Iran launched that unprecedented assault against Israel from Iranian territory, which Iran says was in response to Israel allegedly attacking that Iranian compound in Syria with the IRGC members. And of course, the cycle goes on because they were responding to something else, and they were responding to Iran sponsoring terrorist proxies like Hamas and Hezbollah. So we can take the cycle back years, but where we are right now is Iran is saying any retaliation is going to lead to some kind of devastating response. And Israel is saying that there will be a response. They haven't provided details when, how, what, but they say it's not a matter of if, it's a matter of when. And without getting into the politics here, James, the markets seemingly are shrugging this off. And you seem to also be, if you're thinking that other than an event, you'll get Bitcoin at 100,000. I mean, if you look at the probability, would you think that the markets are a little too complacent?
Well, the markets are always complacent until it's right up in their face, right? So, but okay, a few things. So let's unpack a few things. First of all, if we do have a major geopolitical event like that, I mean, that would be catastrophic. And so it's really difficult to tell what would happen with the markets, with bonds, what kind of flight to safety you'd have to U.S. Treasuries. Like you said before, look, I mean, the Treasuries are they're the cleanest shirt in the pile of dirty fiat laundry, right? So that's where people will run to. They know that dollars are accepted across the world, so it's easy to justify basing yourself in dollars. Okay, so that's number one. Bitcoin, how it responds will depend on where it is in its cycle here, if and when that happens, and what kind of market impact there is, because we still know that Bitcoin responds to these situations in a risk off kind of, in a risk. It's as if it's a risk on asset. So people take risk off the table, sell Bitcoin. We know that's been happening. The response to that, though, the federal response, meaning the central bank responses, should, and I fully expect to be, tremendously liquid. And so they will be dumping massive amounts of liquidity into the markets, which would benefit things like Bitcoin, stocks, gold, and it will be extremely inflationary. Mm-hmm. And so I expect that on the other side of it. Right. So it all has to do with timing. And that's why, who knows what happens this year? We're in an election year. You just heard the Fed come out, and Powell came out, and he keeps reiterating that, look, we're not where we need to be on inflation. We're going to keep rates where they are. Yet at the same time, you've got Congress spending like endlessly. And so they're spending over $2 trillion more than they should be in a balanced budget. So that's where we are. And so if we do have a geopolitical event like you're talking about, yeah, it would be catastrophic. And it's hard to say what would happen to markets. It really depends on the escalation from there, I would imagine.
Right. I mean, look, and then there are degrees of geopolitical events, but I think it seems that I don't think this round is over, at least how the parties are portraying it, given the political situations, both in Israel, both in the US and in Iran. But I get your point that in the response to a geopolitical event, there will be tremendous money printing. And on the other side of that, whatever that other side may look like, that money printing, you're saying, would be positive for Bitcoin and gold. So going into a scenario like this, do you feel more comfortable piling up on gold or on Bitcoin?
Well, I have a Bitcoin hedge fund, so I am extremely exposed to Bitcoin. But gold is a good. Like, I have nothing wrong with gold. I own gold personally. It's a good asset. I mean, if you look back, gold, it has been the base money for thousands of years, right? So that the difference is over the last 100 some odd, we created this fiat system that it's kind of just been this tiny little period in history, and it's failing. We're watching it fail real time. We're seeing tremendous separation of wealth. We're seeing too much, we're seeing control of people. We're seeing the inflation has gotten out of control, and the debt situation and borrowing it's across the board. Every single major developed country that can print money and denominate debt in their own fiat currency are doing that, and we're watching it happen in real time. So gold is it is an excellent store of value long term. You can't look at 2 years, 1 year, 3 years. It's not about that. Go look back in 600 BC, when you could buy 350 loaves of bread with an ounce of gold. Well, you flash forward today, and what can you buy? You can buy about 350-ish loaves of good bread with an ounce of gold. You could buy a toga with an ounce of gold. You can now buy a designer suit with an ounce of gold. It holds value. So people get all tied up and confused about, what does that mean? It doesn't. What about it? It does this against dollars. And just think it a bit about like this. You go out and work. You expend energy. For that, you are compensated from the company or whoever, your clients, whatever. You get that compensation. And if you don't want to spend that all in this moment, and you want to hold on to some of it for future purchases or for future payments for obligations like a mortgage or a car, well, then you have to find a way to protect that. And so gold has been a great way to protect that over long periods of time. Bitcoin will and has been over long periods of time. It's been a tremendous store of value over long periods of time, and it's just in its adoption phase. And so once we get through that, they're going to act, it's going to be very similar. Where Bitcoin, I expect, will kind of take that mantle and be the future money, where in the future, that's the thing that will buy your 350 loaves of bread for, your equivalent of 1 ounce. So
Uh,
that's what we're looking for.
so, in terms of, I know it's hard to get you to give me specific Bitcoin price forecasts, but do you have a target for gold? Let's say by end of 2024? I mean, we're seeing
It
some
really
of the biggest Wall Street banks adjusting their targets on this news, on the inflation news. What does James Lavish have to say?
I would not be surprised if gold is up another double digit return from here going into the end of the year. And so, do I expect it to go to $4,000, $5,000? I do. Not this year, but I do expect that. I fully expect that, because I fully expect the irresponsibility to continue out of Washington, for them to continue to print money, expand the money supply, which just means that you need more dollars to buy that ounce of gold. It's a simple equation. They're going to double the money supply in the next 10 years. So gold will absolutely double in my opinion.
James, let's assume that we take this geopolitical crisis off the table and things are contained, that the markets may be right here, and somehow there's a retaliation, but nothing too explosive. Things don't get too out of hand. Again, we still have this big macroeconomic picture that we've been talking about, and what we can expect from the Fed with rates as they are, with inflation proving to be stickier than anticipated. What are you expecting, again, geopolitical moves aside, from the Fed with regards to hiking potentially in the next year? Because now UBS is saying that perhaps there should be a real possibility of a rate hike in 2025. What are you expecting for a rate cut? What are you expecting from the Fed, assuming that status quo more or less is maintained geopolitically?
Yeah, well, now you just get into take out the geo and just make it political, right? Because
Right, yeah.
as much as the Fed claims that they're not a political engine, they don't answer to the White House, they answer to Congress. They have tremendous pressure from the administration to be cutting rates, and so what we're seeing is that inflation is stuck at about 3%. If and when we get any indication that either of the Fed's mandates, which is stable prices or full employment, if we get movement off of one of those, which we're kind of stuck in a pattern here, if we get movement off of one of those, the Fed will take that opportunity and say, okay, we're going to back off here. Well, how will they do that? Well, the first thing they're going to do is they're going to back off the QT program, the quantitative tightening. All of those bonds that they bought during the pandemic, they're going to start backing off how much they're selling. Why are they going to do that? Well, because they need liquidity in the treasury market. This is really the crux of all of it right here, Michelle. They must have full liquidity in the treasury auctions in the treasury market. If that becomes dysfunctional, that's a massive problem for the treasury and for the government because of all of the deficits that we're running. So what they're going to do is they're watching very closely that the reverse repo has just been drawn down to $327 billion. It's back up a little bit because of tax receipts, but we'll see what that settles out to. That's going to continue to get drawn down by T-bill issuance. So the Treasury issues T-bills. They're using that cash that's sitting on the sidelines in money market accounts. They're issuing T-bills instead, and so they're drawing that money out and putting them in T-bills. Once that's gone, we heard Powell talk about it at the last presser. Okay, he was talking about how he's watching bank reserves, and at a certain point, they get nervous that they need to back off of QT and selling treasuries off the Fed balance sheet because they don't want to compete with those auctions. So what they'll do is they'll start backing off that, which you're seeing kind of happen now that they're rebalancing every single. You're watching these auctions. You can see that SOMA is in there. The Fed is in there rebalancing their book. And so what they're doing is they're watching these reserves, and they know that. And he said this number. They're currently at 3.5 trillion reserves in banks in the U.S. Once that gets down to 2.5 trillion, they start getting nervous, because when it hit 1.5 trillion back in September of 2019, we had dysfunction in the treasury market, and it was a problem. You had the treasury issuing too many bonds that was unexpected. You had tax payments coming due, and you had a lack of liquidity from banks in order to buy the treasuries in the auctions, and it became a problem. And so they had to issue liquid. They had to enter liquidity into the market. And so that's what they're trying to avoid that. They're trying to back off until the point where they can just stop and not have to flood the market with liquidity in order to stem some sort of event that could happen. Because if we have a treasury event, that's a completely different issue. And that would be tremendously inflationary for the markets, because we know that they are going to come in and they're going to flood the market with liquidity in order to stem that problem.
Right. And those inflationary events, bullish for Bitcoin and for gold. As we wrap up here, I want to bring it back to Bitcoin. James, there has been another development. We tend to be a little US, North American focused or centric, but there have been developments in other parts of the world, in Asian markets. We have Hong Kong conditionally approving its first spot Bitcoin ETF. There's also a spot Ethereum ETF that's conditionally approved, but we'll keep it on Bitcoin for now. That's a potentially big development, although there's concern that investors in mainland China won't actually be allowed to buy into the newly approved Hong Kong listed spot ETFs, and that could weaken the excitement over the funds. But we've also got South Korea, with Bitcoin becoming a big political issue over there, and South Korea looking to make spot Bitcoin ETFs open to the public and approving those. What do you see the implications of these Asian markets now having spot Bitcoin ETFs meaning for the price?
Well, Asia has been the focal point for crypto and Bitcoin trading and buying for many years, and so it is a big deal out there for this to be developing. As far as the Hong Kong market. Look, the New York Stock Exchange and the U.S. markets are a factor larger than the Hong Kong market, and so the impact to the Bitcoin price will be much smaller there, in my opinion. And like you said, it's unclear whether mainland China citizens can actually buy those, and if they can, that would be significant in my mind. How significant? Not quite as significant as the U.S. market. You have when you're denominated in the U.S. market, then you're exposed to dollars, which is usually pretty good. So that to me would be it will continue to be the strongest area for these ETFs anywhere in the world. But that said, it is a positive development. It's a tremendously positive development, and I expect more countries to do the same.
What do you think is then the next positive narrative driving the Bitcoin price? Again, let's assume that the world doesn't blow up, Armageddon gets contained. We just have the usual crises of fiat debasement and devaluation and what we're already expecting there. Leading into this year, there was a lot of positive spin about the US spot Bitcoin ETFs being approved. That was a positive driving the price. Then some positivity regarding the halving. What do you see happening as the next positive narrative driver to push the Bitcoin price higher?
My guess would be a positive driver would be that you get a large institution that has to file and announce that they've bought Bitcoin for their balance sheet or in their portfolios. And whether it's an institution or a large company, that ends up out there buying Bitcoin and owning the BlackRock or Fidelity or Bitwise something ETF, and they're holding it on their balance sheet or holding it in a portfolio, and they have no choice but to make that announcement because that's the SEC requirement, and they have to file that they own that, and you'll see exactly what they bought, how much, when, and then you'll have an idea. And I expect that we're going to start seeing some interesting names pop up, and that will be a big positive.
And that, as we touched on, will trigger the FOMO from the others. All right, James, as we wrap up, where can the viewers get more James Lavish? Tell us about The Informationist. I know it's growing in subscribers.
Yeah, so it's a free newsletter, and it comes out every Sunday. And I take one financial concept and simplify it for people. And you can find it. Just go to jameslavish.com. You can find it in on my Twitter profile. I'm often on Twitter. I'm active there. And then we are closed. The Bitcoin Opportunity Fund is closed right now, but I can see there being tremendous opportunity and more Bitcoin opportunity funds in the future. And so if you want to be a part of that or you want information on that, just go to bitcoinopportunity.fund and you can just attest that you're an accredited investor and we can send you some information.
All right. Well, I look forward to that Informationist Sunday reading. As always, James, thank you so much. Really appreciate it.
Thank you, Michelle. It's great to be here and appreciate it.
All right. We'll be watching all of these developments very closely, and we'll be bringing you in to get your insights. In the meantime, that's it for today. James Lavish, thank you so much. And as always, thank you to our viewers for watching. If you are watching us on YouTube, make sure to like this video and to subscribe. For me, Michelle Makori, and the rest of the Kitco team, we'll see you again soon.